Crypto Hotep here with another investing video. We are on the Big 2-0. We are on week 20 with the family portfolio. And if you're unfamiliar with the updates and the family portfolio tracking that I'm doing, feel free to go to my channel, go to week number 1 and see the first video of this series. The long and the short of it is basically I gave my family a list of stocks that I chose based on research and based on how I felt about the stock, and I asked them to pick their favorite companies, favorite stocks, etc. Then we used M1 Finance, which is our broker of choice, to place the stocks in what they call a pie. So every family member of mine has a pie dedicated to his or her own stocks, and each week we track this portfolio. And we also track the performance, our emotions, our thoughts, any analysis, and anything that's going on in the market. These videos, first and foremost, are for my own edification. And if you find them helpful at all, feel free to like, subscribe, comment, let me know what you want to see. And as always, none of this is financial advice. Please consult a professional before you invest or trade in anything, in any stocks, crypto, metals, anything like that. With that being said, we can jump right in here. So before we go into week 20 and see what the balance is, we are looking at week 19. We always look back to see where we were at. So week 19 last week, we were at 767.49, and the weighted rate of return was in the double digits, 13%, with our dividends earned of $4.53. This week, we are a little down here this week. So in week 20, we are at 766.31. Weighted rate of return was dropped down to 7%, a little bit below 7.5%. Our dividends did increase by about 16 cents or so, and now sitting at $4.69. So let's see what's going on here. The markets itself this week definitely pulled back, and we'll be doing a deeper dive into that shortly. So let's go here. From last week, we had a couple of buys. Okay? So we had one buy since we last spoke. I bought some SJM, or the Smucker company, basically the jam company. I bought my first bit of position with that company, which are in my food and restaurant sector of my portfolio. So that was the one buy there. We did get some dividend. This was in my portion of the pie under McCormick the Spice Company. So we got 3 cents there. And as always, guys, the 3 cents, it's not about the number. It's about the consistency in building up that number. So the 3 cents, yes, it is small. And, if you're first joining this video, you're probably thinking, oh, Crypto Hotep, I'm not wasting my time, with you. You're just counting pennies here. These are pennies. You're 100% right. But what I focus on, and what I always tell my family and try to teach my family is, don't focus on the number itself. Focus on the fact that you didn't have to do anything to get this money, because it is still money at the end of the day. And let's focus on increasing that balance and increasing your position in these stocks that do give you this, because increased position will also increase this dividend as well. And then today we did have several buys. So we had Celsius, which was my wife. My wife, I already know, she's the only one that has Celsius as well. So we bought some more Celsius, bought the dip. Costco, Amazon, Nintendo, and we had Starbucks. So I already know this Costco is actually for our oldest, and we will jump into her portfolio in a second. Amazon more than likely is our middle. Nintendo, there's probably a split between our middle and our youngest, and then Starbucks is for probably my youngest as well, or our youngest, I should say. And I think one thing that I will incorporate in here is, because or looking at the holdings is because M1 Finance, they have these dividend income tools here. And me being a focused dividend investor, not all of my stocks are dividend though in our portfolio. I think these tools are fantastic. So, we'll go over this as well. We may not do this every week because sometimes it won't change, but it is good to see. So within the whole portfolio, total income was $10.73. This is for 2024. Paid income here is $4.75. Okay, so this is income or dividends that we've already received. Pending income are dividends that are upcoming, and we'll show you. And then estimated income is literally the rest of it for the rest of the year. So this is just estimating. If you don't add any more money, potentially the rest of your dividends will kind of shake out to $5.74. Average monthly income is 89 cents. Again, just kind of building the portfolio here from a small account. So we can look here. So, M1 Finance gives you a breakdown month by month. The blue bars are basically everything that's paid. The light blue is anything that's pending. And then the estimated is in light gray. Okay. So if we look at it, obviously we've been paid for the whole year up until July. We can see that we have some pending dividends coming in August, which is nice. So you can kind of look ahead. Looks like we have some from Starbucks, Apple, Procter & Gamble. Okay, which is pretty cool. And then you can kind of forecast the rest of the year and where you and your portfolio will be at in terms of dividends. In addition to that, you can see your upcoming dividends right here, as well as the status. So you can see the pending. So we had the pending in August, as you can see here. This is where those August start here that you can see, and you can get a bit deeper dive into what those are. And then you can see a breakdown of your holdings, the yield on cost, the dividend yield, last 12 months paid, which is nice, your average cost for the asset, and then your payout frequency, which is nice. So very nice tools here for all the dividend investors. So back to our portfolio here. Okay, as always, we go bottomed up. So we'll go to mom's stocks, aka my wife. And, she's had a rough go. Okay, so, she is down a little less than 20%, negative $8, $8.50 market gain, and down about 51% on the Celsius holdings. So as you saw, we are still buying the dip on Celsius. I still think that the Celsius holding is and will turn around based on my analysis of that stock last week and how the price is performing currently. I'm still not worried right now in terms of where price is for the stock and what I think it will do. Everything else in her portfolio is solid, and I'm not really concerned about that. Now let's go to our middle. So our middle has a very, very, very consistent portfolio. So weighted rate of return, a little bit under 3.5%. Okay. Dividends earned, only 2 cents. But as you can see here, we have Amazon in the green. Costco has been up double digits for a while now. Nintendo, and then we do have Target. Okay, so down a little bit over 1% in Target. Nintendo's kind of at a break even here. So consistently, our middle has always ironically been in the middle for these portfolios and always been in the green. Let's go to our oldest, and a change for our oldest, which is pretty nice. So our oldest now has 3 companies and 3 stocks that they would like to take advantage of. So as you guys are aware, our oldest always had and built up positions in McDonald's and Apple. Kept it real simple. Well, now we have Costco. Added Costco in here, which is funny because our middle has Costco. So And it's funny how everything worked out. We were actually eating. We were out having dinner together as a family, and our oldest just said, "Dad, I think I want to add Costco to my portfolio." I said, "Okay, okay, great." And our middle actually turned to her sister and said, "You know what? They've actually been doing really well so far. It's been looking really good for Costco." And that kind of that did warm my heart. Not gonna lie, it was funny. It was funny hearing that comment, and it was accurate as well. And it was good to hear. It was good to hear. But with our oldest, weighted rate of return over 7% here, very nice. A quarter on the dividends earned. Apple, just a fantastic position, over 30%. Down over 12% on McDonald's. Still not worried about that. They did raise their dividend. McDonald's did, which is very good. And Costco down over 2.25%. Not mad at that portfolio. That's a good portfolio. 3 quality companies, quality stocks. And now our youngest did take a dip. So Tesla did not have a very good earnings this week. I'm not going to lie to you. The reason why there has been a big pullback on stocks, on the market, on our portfolio is because of earnings this week. Earnings have not been good at all. And this applies to Tesla. Tesla did miss on the earnings per share, was up on the revenue, which is good, but the earnings per share, they were off. Even with this, our youngest still up double digits, over 17% year to date, weighted rate of return. Nintendo in the green. Tesla still up over 35% because our youngest got a really good piece of Tesla at a really good price. Remember several months ago when Tesla was bleeding very profusely, we still bought into Tesla. We still bought the dip. Similar to how Celsius is, where there was a whole bunch of FUD about the company. They said it was over. And then what happened? Nope. Price turned around and now we're up again. So despite all that, up over 35% in Tesla. Again, similar to our oldest, up over 25% in Apple. Fantastic. And then Starbucks, we're still buying the dip on Starbucks, down over 7.5%. This is a very good portfolio, though. Okay, and last but not least, we are looking at mine. Up over 5%. Dividends earned, $4.25 here. And, as our middle, I've been pretty consistent. This portfolio has been pretty well. It's been performing really well this year so far. Technology has been the game changer. Industrials has also been the game changer. Real estate has finally ticked up here. If you've been following, you probably know that I did add O into that kind of real estate sector. As you can see, monstrous, just up over 9% in the real estate sector here. Finance up over 6%, and then pharmaceuticals, which is doing pretty nice with J&J and Pfizer, up over 7% as well. So not bad at all here. A couple of things though. So we are down over 1% in restaurant and foods. Coca-Cola, the GOAT, not worried about that. I'm going to buy some Coca-Cola. That's why you see these 2 little arrows here. Texas Roadhouse, again, up over 10% with Texas Roadhouse. But Starbucks, we're bleeding out on that position. But we will be buying the dip on Starbucks. I'm still holding. McDonald's still holding. And then Smucker's down over 3%. We're still holding there. Domino's didn't have a good outlook, I believe, on earnings. So that's why they're down. But still buying Domino's. I'm not giving that up anytime soon there. And then the meme stocks. This is where the meme stocks really come into play. And if I can quickly go here with the meme stocks. So you see the target allocation for the meme stocks is only 3%. It's not a lot. It is not a lot. And the reason is because you can have these huge swings of the meme stocks, and they typically are the first ones to go when the market just crashes. So, or when the market dips, I should say. So, weighted rate of return down over 3.5%. A lot of that is carried because of CrowdStrike. CrowdStrike is down over 33%. UPS, awful earnings as well this week, down almost 8%. And then Robinhood down, little only 1%. The only ones that are carrying is Palantir and then DTE, which DTE did have some good earnings this week. So, with that being said, guys, we have a balance of 766.31. Weighted rate of return still good at over 7.25% at 7.41% year to date. And, we're closing in on that $800 mark. And it feels good. If you've been following us, we've been here for 20 weeks, which is about 5 months. Time does fly. And I've been really liking these updates because it does show the progress. Investing does take time. Investing takes time. If you're trying to get rich quick, get a lotto ticket, invest in a meme coin, or not invest, but trade a meme coin very quickly, get your money and go. Investing really takes time and effort, and this shows this. Again, this is a small account that we're trying to build up and track the progress of it. So, I'm very proud of what my family and I have been able to do here. So, one thing that I will say, and I do want to get into really quickly, I know I'm getting up on time here, is the earnings. The reason why the pullback did happen with these stocks, a lot of the companies this week had really not very good earnings, missed earnings, such as Verizon here. Revenue missed. Their earnings per share was stagnant here. Let's go to Tuesday. Google was okay, but they did have their guidance on it was a little weak. Tesla missed on the earnings per share, but their revenue was up. Visa was in line with their earnings per share, but their revenue was down. Louis Vuitton missed on both. Coca-Cola was the savior, as always. They're very consistent, hit on earnings per share and hit on revenue, double. General Electric missed on one. Okay, Comcast missed on one. UPS missed both. Let's see, Spotify missed on one here. So it seemed like that as I was getting these notifications that a lot of companies were either missing both or missing one or the other. And so that really played in effect with the pullback in the market. And really quickly, if we go to the chart and we look at the S&P 500 through VOO's eyes, or the Vanguard ETF, you'll see here that, okay, we've had from April 29th until now, we've had a really good run up here, right? Now, from my perspective, when it comes to chart analysis, and we just keep this really simple, this is looking like some weekly resistance right here. If this closes and we have less than a day, we have about 16 hours right here. But if this candle closes here red, I would consider a little bit more downside here. And my thought is we're gonna have more dip to buy next week in the markets, and potentially we could see a revisit back to 480 for VOO, which would be a dip in the S&P 500. So don't be alarmed with that. Dips are for buying, but we had a good run up, guys. And if you look at the slow stochastic here, we've been in overbought status since November 2023, and we had this little dip here, but we didn't even hit 50 on the slow stochastic here, and we're still in overbought status here. So usually a pullback is needed. We didn't have a pullback here. This is not a pullback, right? This is kind of a little dip in price and then a boom, a move back up. I would consider this a pullback where you have overbought overbought status on your slow stochastic, price begins to dip down, and it finally gets to oversold, and then you have the run up. So don't be surprised if we go down here into this level into 480 again. My concern or my area of interest would be a low right here at 453. So that's where my eyes would go, where what I would be thinking is if price dips below that area, then we would see some more downside potentially. So if price starts trading below this area, then we would more than likely see a 420 VOO or S&P 500 here. So I would not like that to happen. I would like for something like this to happen where we get price to come down into this level of value here, this 480 level, for just a spring up, or potentially have a quick run down to grab this low and then a move back up. So I know this is a little longer video, and we're going to cut it off right now. But as always, guys, thank you for watching. Hope these videos are helpful. If they are, again, feel free to like, comment, subscribe. Let me know what you think. And as always, thank you and happy trading.